Welcome to a short video to explain how a waterfall profit distribution model works. Maybe just to start, there are different ways to do this. I've seen all kinds of approaches. I just would like to show you one way to do this by modeling basically the profit distribution via a four-tier hurdle structure by focusing on the IRR return investors can achieve with a specific deal. This model basically needs that you enter the cash flows available to investors based from a real estate deal or from a private equity deal as the base cash flows which are available to distribute. Once we have that, we need to basically set to look at the investment structure, how which investors or which types of investor participated in this project. And normally we have two types of investors. One type of investor is the promoter, which basically leads the project, and the other one will be the silent partner, the limited partners who are basically investing the model, but they don't take an active role in this. So what will happen is that all these limited partners, they are dependent that the promoter performs or maximizes the return of this investment project, and therefore they need to incentivize him to reward a good performance. The way to do this is to set up or to define a profit sharing model, which normally is written in form of a shareholder agreement or also investment agreement. And basically the principles of that is that the investors aim to achieve a target return, and if that return is exceeded, the excess profits will start to be distributed unevenly among the two types of investors. So for instance, in this case, until a 8% return is achieved, basically the profit distribution is same as the investment structure here. Promoter gets 10%, he also gets 10% of the profits until 8% return is achieved. However, if he performs better, then the story will start to look a bit different. If, for instance, he achieves a 15% return, then we can say here that he from 8 to 15%, that he will get 15% of the profits. And if he achieves, for instance, here the third hurdle, which would be at a 20% IRR targets, then he gets even 20% of all the returns. For anything above, the promoter can be even incentivized to even get a higher share of the profit share. So you see basically here the allocation of the incentive structures up to 8%, you have 10%, and then here this is basically rising. And now what you can do is you can enter the cash flows of your deal. For instance, we can here change this a bit. We can enter a different deal assumptions. Mostly at the beginning this is a minus because it's an investment required. Then here we have some plus cash flows. Sometimes you have a refinancing in between, sometimes not. So in this case I set this back to normal cash flow patterns. So let's say these cash flows are distributed like this, and what this means is that the deal overall has a 17% IRR. We have to invest 3 million, and basically at the end we'll get a profit of the deal of 4.2 million because here we are selling it at 6 million. So now how this waterfall model works is that we look at first, the limited partners investment. Out of this 3 million which is needed to invest, they will have to fund basically 90%, which is here. So this means they have to invest 2.7 million. And what they need to achieve is an 8% preferred return. This means they have to basically get a profit of 216 million. In the first year there's not enough cash flow available to pay that, so basically we pay what we can. We just pay 90% of this 50,000, but this also means that the ending balance goes up, so that we have to we need a bit more. We need then here also the other years to make up for that. And this basically goes on. So every year we calculate what is the 8% preferred return required on the last on the capital balance, and then we do here the calculation. And in this case, it basically means that you need up to the year of exit to basically fully pay back the 8% return and also pay back the principal investment, so that the capital ending balance gets to 0. This also means that in the first 5 years, the promoter, he just gets the 10% of this deal as per the investment agreement, and there is no cash flow remain left to basically go into to achieve a better hurdle than 1. Hurdle 2, hurdle 3 are then more relevant in the year of the exit, once we have here cash remaining to be distributed in form of hurdle 2. So what we do here is we take this cash and then we distribute this as per hurdle 2. We can then also, here we have the same kind of calculation that we see how much is the capital balance and how much is needed to basically pay for achieving the hurdle 2. And in this case, we have a different profit allocation. The promoter gets 15%, so this means he gets here a higher share of the available cash to be distributed. We have even some cash remaining. This goes then into hurdle 3. Here we have the same type of calculation, only that the balance will be bigger because we have to achieve a 20% IRR. And then basically this means we have some cash. We see how much cash is left to be distributed. In this case, we get 80% goes to the LP and 20% goes to the promoter. And this basically, in this case, this is it. In case there will be more cash available, it will go even into hurdle 3. And now what we can see here, we have here a check. So we see what is the cash flows calculations from hurdle 1, and we check if that is corresponding to the target return. Target return of hurdle 1 is 8%, so that's fine. Hurdle 2 is 15%, that's also fine. Hurdle 3 is only 16% because we used some of the cash to pay for the hurdle 3, but it's not all. It would need to be fully. We can, with a deal IRR of 17%, we of course cannot beat the hurdle 3. So that's the reason. And then the model basically seeks to summarize the cash flows for the view of the limited partners and also the view of the promoters. In this case, we also look at the cash on cash yield, meaning the yield if you invest, basically the annual cash yield received in relation to the investment. This is more relevant if you are not exiting that soon. If you're more seeking to do a buy and hold, then you might be more interested in that figure rather than the IRRs, just for information purposes. And in this case, we basically have here the LPs have an IRR of 16% and the promoters have an IRR of 21%. So now let's look at the overall picture. So here, as said, this is the overall metrics of the deal, of what the promoters get, limited partners get. Limited partners will always get or normally should get, if it performs well, should get a lower IRR than the deal because they have to shift some profit to the promoters. And in this calculation, we can basically calculate what expected profits and the IRR is for these parties. And in this case, if the limited partners basically would seek to achieve minimum at 20% return, then we will have to go back and revise our business case as obviously as a 16% IRR is too low to compensate them for the risk. So let's say we can do a bit better at exit. And now let's check. So if we do better at exit, we're still at 19%. The promoter gets up, gets a bit better because we have to pay him for the performance, but it would still not be enough. So we would have to go back again and revise these cash flow until the limited partners are satisfied with what they think they can achieve with this deal. We also have here some graphics. We can look at, as said, as the IRR. We can also look at the average cash on cash yield. This includes the exit the exit value. We also want to look at the risk and the reward. You can see that here the promoters, they put in 10% of the capital and they should get 15% of the proceeds. This then leads to discussion if that is sufficient for all the parties to do it, and it's basically can be used. This model can then be used also as a tool to negotiate the terms of the deal. So that's basically it, how this works. There are, of course, many some additional complexity which can be added, but my goal is more to show you the basic principle how a waterfall profit distribution model can work. I hope this video was useful. If yes, please give it a thumbs up, subscribe to our channel, and please also visit our website efinancialmodels.com. Thank you for watching.